What if the exact moment you feel the most intense urge to panic and sell everything is actually the greatest wealth building opportunity of your lifetime? Imagine watching a decade of hard earned savings evaporate in a matter of weeks, the red numbers on your screen mirroring the rising panic in your chest. This is the ultimate test of financial fortitude, a crucible where the majority surrender to fear, yet a rare few step forward to claim unprecedented fortunes. How do these rare individuals override their primal instincts to run, choosing instead to walk directly into the fire of an economic meltdown? The 2008 financial crisis serves as the perfect laboratory to understand this phenomenon. When global markets plummeted, over $19.2 trillion in wealth vanished almost overnight, paralyzing the average investor. Yet, while the masses liquidated their portfolios at catastrophic losses, crisis investors were systematically deploying capital. To understand this chasm in behavior, we must examine behavioral economics, a field of study that combines psychological insights with economic theory to explain why people make irrational financial decisions. As demonstrated by the pioneering work of psychologists Daniel Kahneman and Amos Tversky, human beings are not perfectly rational calculators of risk and reward. The core of this irrationality is deeply rooted in loss aversion, a psychological bias where the pain of losing money feels psychologically twice as severe as the joy of gaining that exact same amount. During market downturns, this bias triggers a primal flight response, blinding everyday savers to long-term potential and forcing them to sell at the absolute bottom. Crisis investors, however, have trained themselves to recognize this biological hijack. They understand that market crashes are not the destruction of wealth, but merely the aggressive transfer of wealth from the panicked to the patient. By mastering their own psychology, they transform widespread terror into a strategic advantage. This mastery forms the foundation of contrarian investing, a strategy built on deliberately moving against the prevailing market sentiment. When the herd is driven by unbridled greed, the contrarian is cautious, and when the herd is paralyzed by fear, the contrarian is aggressively buying. According to historical data compiled by the National Bureau of Economic Research, the most significant long-term market returns are consistently generated by capital deployed during periods of maximum economic pessimism. The contrarian does not act out of blind rebellion, but relies on rigorous valuation metrics, recognizing that panic artificially depresses the price of fundamentally sound businesses and properties. The landscape of a crash is littered with distressed assets, which are financial instruments, properties, or companies forced into liquidation at steep discounts due to the seller's urgent need for cash, rather than the asset's true intrinsic value. In 2008, prime real estate and blue chip equities were frequently trading at a 40.5% discount to their historical worth. The sheer scale of the sell-off created a unique pricing anomaly where the intrinsic value of these assets became entirely decoupled from their market price. For those with the vision to see past the immediate economic wreckage, these distressed assets represented the raw materials for future financial empires. But recognizing a bargain is useless without the means to acquire it, which dictates the absolute necessity of maintaining strategic liquidity. Long before the storm hits, the elite wealth builder is hoarding cash and securing access to credit lines, deliberately sacrificing marginal short-term gains for absolute purchasing power during a crisis. This disciplined cash position is the heavy artillery of the crisis investor. When credit markets freeze and traditional lending evaporates, cash becomes the ultimate kingmaker, allowing the prepared individual to dictate terms to a desperate market. This level of preparation requires a profound understanding of asset allocation, the strategic distribution of an investment portfolio across various asset classes like stocks, bonds, and cash, to balance risk and reward according to an individual's specific goals. Proper allocation ensures that a portfolio can absorb the violent shocks of a crash without facing total ruin. The prepared investor does not need to liquidate high-quality holdings to survive a downturn because their defensive assets provide the necessary buffer. This structural resilience is what grants them the psychological freedom to go on the offensive while others are fighting merely to survive. A critical component of this defensive structure is diversification, the practice of spreading investments around so that exposure to any one type of asset is limited, effectively reducing the volatility of the overall portfolio. By holding non-correlated assets, investments that do not move in the exact same direction under the same economic conditions, the savvy operator ensures that a collapse in one sector does not trigger a cascading failure of their entire net worth. This calculated spread of risk is the bedrock upon which aggressive crisis acquisitions are safely built. The fortified portfolio survives the initial blast, preserving the capital needed to buy the resulting debris. The ultimate reward for this calculated courage is the explosive acceleration of compound interest, the financial phenomenon where the interest earned on an initial investment begins to earn interest on itself, creating an exponential growth curve over time. When you acquire assets at a severe discount during a panic, you dramatically amplify the base upon which this compounding occurs. As the economy inevitably recovers and asset prices return to their historical means, the crisis investor experiences a multiplier effect on their wealth. A study published in the Journal of Finance highlights that portfolios heavily weighted with assets acquired during deep recessions consistently outperform standard dollar cost average portfolios over a 20-year horizon. We see this multiplier effect most vividly in the realm of tangible property acquisition. During the depths of the housing collapse, sophisticated operators bypassed the speculative frenzy that caused the bubble and focused entirely on cash-flowing multifamily properties. By purchasing these buildings at distressed valuations, they locked in historically high capitalization rates, ensuring immediate passive income streams. Furthermore, they secured long-term, fixed-rate debt at artificially suppressed interest rates, turning inflation into a silent ally that would slowly erode the true cost of their mortgages over the coming decades. The resulting cash flow from these acquisitions provided an impenetrable shield against further economic instability. While the broader public panicked over the daily fluctuations of the stock market, these real estate operators were insulated by the consistent monthly rent checks collected from their growing tenant base. This tangible yield allowed them to comfortably service their debt and continuously stockpile new capital. They effectively engineered a self-sustaining wealth machine that operated independently of Wall Street's manic mood swings, proving that profound wealth is often built in the quiet, unglamorous execution of fundamental principles. Beyond the stock market and real estate, market crashes forge a brutal but fertile landscape for entrepreneurship. Recessions act as a massive economic clearinghouse, ruthlessly purging inefficient businesses and exposing vast gaps in the market. The visionary founder sees these gaps not as voids, but as unserved demands waiting to be captured. With competitors retreating, advertising costs plummeting, and top-tier talent suddenly seeking employment, the cost of launching and scaling a disruptive enterprise drops precipitously. The empires forged in the fires of an economic downturn are inherently leaner, more resilient, and perfectly positioned to dominate the subsequent recovery. Yet, it is vital to acknowledge the immense psychological toll exacted by walking this lonely path. Buying when there is blood in the streets means ignoring the screaming headlines, the panicked advice of peers, and the relentless, sinking feeling in your own gut. Every biological instinct demands conformity with the terrified herd. Maintaining conviction requires a mental fortitude that borders on the stoic, an unwavering belief in historical market cycles and the fundamental resilience of the broader economy. It is a daily, grueling battle against self-doubt, waged in the silent hours of the night when the portfolio is deeply in the red and the promised recovery seems entirely theoretical. The echoes of those early struggles still shaped their decisions, but the seasoned crisis investor anchors their sanity to objective data rather than subjective emotion. They meticulously track corporate earnings, demographic shifts, and fundamental valuations, refusing to let market hysteria dictate their reality. By defining their entry and exit parameters long before the crisis ever materializes, they remove the burden of in-the-moment decision-making. This pre-planned framework acts as a psychological lifeline, tethering them to logic when the financial world around them descends into chaos. The lessons from that early setback never faded for those who navigated the 2008 collapse successfully. The wealth they accumulated was not merely a personal victory, but the foundation of a lasting legacy that fundamentally altered the trajectory of their family trees. They transformed a generational trauma into a generational shield, securing access to elite education, premium health care, and the ultimate luxury of time for their descendants. This is the true power of mastering the crisis mindset. It is not just about accumulating numbers on a screen. It is about buying the freedom to dictate the terms of your own existence and insulating your bloodline from the unpredictable storms of the global economy. This multi-generational perspective requires a profound shift in how one views time itself. The amateur investor operates on a timeline of days, weeks, or months, constantly reacting to the immediate noise of the news cycle. The seasoned wealth builder operates on a timeline of decades, measuring success not by quarterly gains, but by the permanent elevation of their family's socioeconomic baseline. By establishing irrevocable trusts and family offices with the assets acquired during the crash, they ensure that the wealth survives their own mortality. They are not merely building a portfolio, they are constructing an economic fortress designed to stand for centuries. As we look toward the future, the mechanics of market downturns continue to evolve, driven by algorithmic trading, unprecedented monetary policy, and the relentless speed of digital information. A modern crash can materialize in a matter of days rather than months, accelerating the cycle of panic and recovery. However, while the speed and the catalysts of the crises change, the underlying human reactions remain stubbornly constant. Fear and greed are hardwired into our neurobiology, guaranteeing that markets will continue to wildly overshoot in both directions. The vigilant observer knows that the next major dislocation is not a matter of if, but exactly when. Preparing for this inevitable dislocation demands a ruthless audit of your current financial architecture. It requires aggressively paying down high-interest consumer debt to eliminate forced cash outflows, building a formidable war chest of liquid reserves, and stress testing your income streams against severe macroeconomic shocks. You must cultivate a deep, specialized knowledge in a specific asset class, whether that is commercial real estate, dividend growth equities, or private business acquisition. When the next tidal wave of panic breaks, you will not have the luxury of time to learn the fundamentals. You must already possess the expertise required to strike with surgical precision. Ultimately, thriving in a crisis requires a complete redefinition of how you perceive risk itself. The amateur believes that risk is the volatility of asset prices, viewing a temporary drop in portfolio value as a permanent loss. The master understands that true risk is the permanent destruction of capital, or worse, the failure to achieve financial independence because of a paralyzing fear of the unknown. By embracing volatility as a mechanism for opportunity rather than a signal of doom, you strip the market of its power to terrorize you. You elevate yourself from a passive victim of economic cycles to an active architect of your own prosperity. Your vision of financial freedom must fuel you through the darkest economic winters. When the next collapse inevitably arrives and the sirens of financial doom are blaring, you will not be among the masses scrambling for the exits. You will stand firmly in the wreckage, armed with liquidity, armored by psychological resilience, and guided by the timeless principles of value. You will see clearly what others cannot, that the ashes of a market crash are the exact soil from which true, enduring wealth is grown.